inflation is good for gold. It's not bad for gold, but the markets react to stronger than inflation news as a sign that the Fed has to fight harder to win the battle against inflation. And gold ends up being collateral damage in that inflation fight because it means the Fed's going to have to hike rates or not cut rates or whatever the markets expect. It means the Fed will be tighter than what it might otherwise have been if the inflation numbers were lower. But all of this misses the bigger picture that the Fed has already lost the inflation battle. That's what all these hotter than expected inflation numbers show. And so the fact that inflation keeps coming out worse than expected is not bearish for gold because it means the Fed's going to have to fight harder to beat it. It's bullish for gold because it means the Fed can't fight hard enough to beat it and that inflation already won.
The financial markets often react in counterintuitive ways to economic reports, treating strong inflation data as bad news for precious metals. This short-sighted volatility stems from the belief that aggressive central bank intervention will successfully tame rising costs, temporarily dragging gold down as collateral damage. Peter Schiff, a renowned economist and financial commentator, argues that this common market narrative completely misses the bigger picture because the battle against inflation has already been lost. He emphasizes that hotter-than-expected numbers are actually incredibly bullish for gold, as the Federal Reserve lacks the true capacity to bring prices back under control. With consumer prices predicted to remain permanently elevated, the purchasing power of paper currency will continue to erode rapidly over the next decade. This systemic failure means physical gold is poised for an unstoppable long-term upward trajectory as a critical wealth protector. Now, we present the clips from Peter Schiff's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Gold traded back below $4,000 an ounce, although it didn't close below $4,000. But I believe one of the reasons that gold sold off sharply yesterday was the anticipation of today's inflation report that may not have come in as good as had been hoped. But also, I think traders were trying to price in some type of hawkish statements coming from Warsh during the congressional testimony. So I think they wanted to sell gold into these news events. But again, this still mixes the bigger picture that inflation is good for gold. It's not bad for gold. But in recent years, and I've highlighted it on this podcast, how ridiculous this is. But the markets react to stronger than inflation news as a sign that the Fed has to fight harder to win the battle against inflation. And gold ends up being collateral damage in that inflation fight because it means the Fed's going to have to hike rates or not cut rates or whatever the markets expect. It means the Fed will be tighter than what it might otherwise have been if the inflation numbers were lower. But all of this misses the bigger picture that the Fed has already lost the inflation battle. That's what all these hotter than expected inflation numbers show. And so the fact that inflation keeps coming out worse than expected is not bearish for gold because it means the Fed's going to have to fight harder to beat it. It's bullish for gold because it means the Fed can't fight hard enough to beat it and that inflation already won. In fact, I think inflation has been above the Fed's 2% target for almost 6 years. If the Fed had the intention or the wherewithal to bring inflation down to 2%, it would have already done it. The fact that it's been talking about it for 6 years yet has not achieved this objective, despite constantly predicting that inflation will be back at 2% in 2 years. And again, I went over in prior podcasts that this prediction is not based on any concrete evidence. The Fed just predicts that inflation will be back to 2% because that's their target. And so they just predict that they're going to achieve their target, and they come up with a 2-year time frame just randomly out of the blue. So it's all just hope, but it never happens. And the reason that inflation is not back below 2% is because the Fed can't bring it down to 2% without doing a lot of other things that it doesn't want to do. And we've been focusing on the fact that Kevin Warsh has said that inflation is a choice. And again, that came up in today's hearing. But it is a choice that Kevin Warsh is going to make. In fact, he's already made that choice. He's just not letting the public know that he's made the choice. He's just BSing them with the rhetoric. But anyway, let me get to the inflation numbers that came out this morning. So the expectation for inflation in June, headline, was for minus 0.1. And that would be a big improvement over the plus 0.5 from the prior month. We actually got minus 0.4. So a much bigger drop in the May CPI than had been expected. Year over year, in the prior month, we were at 4.2% year over year CPI increase. Because of the lower increase or the drop in June, the year over year increase is now just 3.5%. So that's a big drop from the prior month, and it's lower than the 3.8 that had been expected. Good news there, right, on lower inflation. And the core ex food and energy was unchanged on the month versus the expected rise of 0.2, which was what we had in the prior month. And the year over year core went from 2.9 in May to 2.6 in June. So the markets immediately celebrated. Bond yields fell, bonds rose, and gold spiked $100 an ounce. Now, first of all, it's not even really good news on inflation because the main driver of the 0.4% drop was the oil price decline. Oil was down about 30% in May. Why? Well, because supposedly the war with Iran was over. We had the MOU, we had the ceasefire, so oil prices went down 30%. Well, now the ceasefire is off, the war is back on, and oil prices, which are now back up at $80 a barrel as of right now, oil prices are up 20% so far in July. So July is only half over. It's possible that the entire drop in oil prices that we enjoy in May, or in June rather, because the war was off, are going to be taken away in July because the war is back on. So why even celebrate what really amounts to a meaningless number? What's more important is that we're way above 2%, and we're not going to get anywhere near 2%, no matter what the Fed does. And of course, what's more problematic is that these are the government numbers, the official government measures of inflation, which maybe capture half of the actual price increases that Americans are forced to endure. Now, gold gave up about half of its $100 gain by the end of the day. I think gold ended up closing up about $50 on the day. We closed just above 4,050. Silver up about $1, closing at 58.58. It got clobbered a couple of bucks yesterday, but I think the most significant action was in the bond market because the bond market lost almost the entire gain. By the end of the day, the yield on the 30-year Treasury was back up to 5.1, and the 10-year is back to 4.59. So almost the high watermarks, despite this better than expected inflation number. Now, one of the reasons there could be some nervousness surrounding tomorrow's release of the PPI. We're going to get that tomorrow morning before we get day 2 up on Capitol Hill. And the producer prices have been coming in a lot hotter than consumer prices. Of course, the producer prices are also going to benefit from the drop in oil prices that we had last month, which is pretty much being undone this month. So again, I don't know why the markets would pay attention to such backward-looking data that is really irrelevant, but that's what they do. And this is how these algorithms are programmed, and they trade off the numbers. I just think that people should take advantage of any of these moves. In fact, when people believe that inflation, higher inflation, is bad for gold, when in fact gold is an inflation hedge, and the more inflation we have, the more you need to hedge yourself, should take advantage of this misguided idea that higher inflation is somehow bad for gold because it means the Fed has to fight harder to bring inflation down. What it really proves is that the Fed can't bring inflation down. It doesn't have the wherewithal or the ability to do it because of all the other problems that would be exposed if the Fed were to do that.
Recent drops in the consumer price index were celebrated by Wall Street, but a closer look reveals this relief is entirely temporary. The primary driver was a 30% drop in crude oil prices due to a brief regional ceasefire, which has already collapsed. With hostilities resuming, energy prices are already up 20% in July, predicting that the entire drop in oil prices from June will be completely taken away. This rebound in energy costs foreshadows a rapid return of hotter producer prices and sustained upward pressure on consumer goods. Mainstream market algorithms are trading on backward-looking government data that fails to reflect the actual cost of living. Consequently, underlying inflation will continue to surge, predicting a bearish environment for bonds, while triggering a massive long-term rally in precious metals. Now, let's get back to the interview.
Warsh admitted, in hindsight, that a key mistake that the Fed made was that it attempted to raise the inflation rate. They were trying to get a little bit more inflation, and that was the reason that we ended up with a lot more inflation, and that was a dangerous policy to deliberately try to raise the inflation rate, which is what I was saying for years. It shouldn't be that 2% is a target. 2% should be the ceiling, which again is where the 2% number came from. It was introduced in New Zealand, the first central bank to have an inflation ceiling of 2%. How that ever became a target, I don't know. It didn't mean that if inflation was 1%, you had to work to get it to 2%. It meant that as long as it was under 2%, it was okay. 1% was better than 1.5% because you were further beneath the ceiling. But as the inflation rate got close to 2%, if it got to 1.8, 1.9, that would mean you'd have to act, because if you didn't act, it might get above 2. But the way we were conducting monetary policy, the way the ECB was conducting monetary policy, if we were at 1.8, that wasn't enough. That the central bank had to tweak the rate up to 2%, which was ridiculous. If you're at 1.8%, why not leave well enough alone? Hey, we're pretty close to 2%. Why risk going over 2%? And in fact, we even made it worse in the US. And I criticized this real time. When we got a little bit above 2%, the Fed came up with an asinine approach called inflation averaging and said we now have to make up for all the years of being below 2%. We now need to run above 2% for a little bit to average the inflation down, which at the time I said was complete nonsense. And Kevin Walsh now agrees with that. Why should we have to tell Americans, look, because you got lucky for a few years and your prices only went up by 1.8% a year, or not lucky, you got gypped, right? You didn't get the 2% inflation that we promised you. You got ripped off and your cost of living only went up 1.8%. So now we're going to get you even. Now we're going to make sure you get 2.2% inflation for a while so you can get the 2% average that you're hoping for, right? That's effectively what they were saying. But I said real time, okay, if they're going to target an average rate of inflation of 2%, what are they going to do when inflation is way above 2%? And now it requires inflation below 2% to bring the average down. I said, are they going to target an inflation rate below 2%? No. What did they do with inflation averaging? They tossed it, right? As soon as it became inconvenient, they abandoned the whole concept, which means, and this is what I said at the time, the real goal was to enable more inflation. So they made up this BS that they had to average inflation up. But the minute the shoe was on the other foot and they needed to average inflation down, forget about it. Oh, we don't want average inflation anymore. We just want to bring it down to 2%, no matter how many years it's above 2%, and no matter how far above 2% it is. Meaning, if it's at 10% for 3, 4, 5 years in a row, our goal is not to try to average it down. We just want to bring future inflation to 2%. So the minute you get way above 2% trend, I mean, you're never going to get back down, which shows that the whole policy is nonsense. And of course, there's all sorts of reasons, and I've gone over that over time, that the 2% target is all a bunch of BS. It was all about justifying inflation. And the only time the Fed ever had a 2% target was when they were below it. So they can use it as an excuse to have higher inflation. We never had a 2% target when it was 4 or 5 or 6%. The Fed invented it. Now, of course, they made that bed, and now they got to lie in it, which they can't.
Historically, the 2% inflation target was originally conceived as a strict ceiling rather than a target to actively pursue. Central banks catastrophically shifted this paradigm, choosing to actively manipulate interest rates to force prices upward under the guise of healthy economic growth. This dangerous policy was further exacerbated by the introduction of inflation averaging, a strategy quickly abandoned once it became highly inconvenient. This misguided strategy predicts a bleak economic outlook where central banks can no longer lower inflation without exposing massive systemic debt and banking vulnerabilities. The artificial manipulation of monetary policy has left the global economy highly vulnerable to a prolonged stagflationary environment that will devastate standard retirement portfolios. As paper and fiat currencies continue to lose their intrinsic value, tangible wealth preservation will become the only viable strategy for smart investors. The era of cheap credit is predicted to be permanently over, making real assets and physical gold the premier vehicles for wealth protection. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.